All right, good morning. My name is Brendan Ahern. I'm the Chief Investment Officer of KraneShares Exchange Traded Funds. As many of you know, the roots of our firm were really founded in China, where our founder, Jonathan Crane, lived in Shanghai in the early 2000s, where he built a successful business geared to China's growing urban middle class. And that led to the development of KraneShares, a exchange traded funds firm focused on growth opportunities in China. And we're obviously well known for KWEB, our China Internet ETF, which is really just I call it a growth factor for China. But we also offer that same exposure in broad emerging markets. KEMQ is the EM version of KWEB. And we've taken trends we've seen in China and applied it to global markets. We did the first global electric vehicle ETF back in 2017, based on what we saw with Tesla in China. But certainly, we've done more recently efforts in artificial intelligence with AGIX, which uniquely owns some great private companies in a publicly traded ETF. And more recently, we've taken what we've seen with the growth of robotics, not just in China, but in broader Asia, and listed COID. But we've also pioneered carbon credit allowance trading, as well as launched ETFs on behalf of partners like Quadratic Capital and Nancy Davis with iVol, or Hedgeye Research with KSpy, Mount Lucas, Camelon. But more, my focus has always been in China. It's really part of what got me to quit my job at the largest asset manager to help make Jonathan Crane's vision investable, that I saw the things that he saw and thought about it from an indexing perspective. And one of the great resources for us on this journey over the last 12 plus years has been the insights from Gavekal Research. We're so honored to have a longtime friend of the firm. I'm like one of these, in the US, you have these people dial into sports radio and they always say, first time caller, long time listener. And this isn't our first call together, Louis, but you were certainly long time consumers of the research of Gavekal, specifically your China efforts, Gavekal Dragonomics. And I'm really excited to hear about some of the things you're doing on tech in China from a research. But maybe, Louis, it would be great maybe for those joining us today who are less familiar with Gavekal. Can you give us a little bit of your background, the roots of the firm? What is Gavekal Research all about?
Sure. Well, first of all, thanks a lot for having me. It's a real pleasure to be here in New York. To be honest, talking about myself is probably the least interesting thing to do today. But I'm originally French, studied in the US, started working in the financial industry in France. The bank I was working for sent me out to Hong Kong in '97 for a 2-year stint. That was about 30 years ago now, still there. Created my own research firm in the late '90s with my dad, Charles, and a friend of ours called Anatol Kaletsky. And we were lucky enough to sort of capture the wave of Chinese growth, to be in the right place at the right time, to study how not only what was happening in China and Chinese financial markets, but how China was really impacting the rest of the world. And to be honest, we've been at it ever since. We've obviously grown the firm since then and gone in different directions, but that's probably enough about us.
Okay, well, you're being very humble. I mean, but Louis and the broader team just do outstanding work, and so we're paying subscribers in full disclosure, and always we love your insights. You and the broader team. We had Tom Miller a few years ago, which was just fantastic. But we were really excited to have you here in New York, and I think one of the things that just going back to a trend that you point out. And this is on, we're not going to walk through a slideshow, but on slide 4, you have this great chart, something that we've been really focused on, which is the decline in real estate. From my trips to China this year, really over the last 2 years, the number one topic is the decline in real estate prices, the knock-on effect on consumer confidence, consumer consumption, this deflationary spiral we've seen. You show that on slide 5. But I think the main thing, showing this deflationary spiral, but going back to slide 4, you bring up such a good point, which is all of this money that went went into real estate. Where is it going? And I thought this was, you and the team, I'll give you full credit, the industrials, but maybe give us your boots on the ground view, the what's happened with real estate and the deflationary effects, but then, you bring up this great point about that money going into the industrial sector.
So to be honest, this chart here on page 4, I think if a picture's worth 1,000 words, this is it. This picture is really the best illustration of what's happened in China over the past 7-8 years. And essentially, you reach a breaking point in 2018. And in 2018, what you had was the US embargoing the sale of high-end semiconductors to China. And I think if we take a step back, we can probably conclude that the Chinese government, perhaps panics, perhaps overreacted, call it what you want. But essentially, I think the Chinese government thought, okay, they're embargoing on semiconductors today. This is no longer a trade war. This is a tech war. The US is trying to prevent us from growing. And therefore, if it's semiconductors today, tomorrow it could be chemical products. It could be auto parts. It could be any number of things. We have no choice but to become self-sufficient and resilient in every single industrial vertical. So the Chinese government essentially at that time tells the banks, guys, no more loans to real estate, no more loans to the consumer, just all the money has to go to industry. We have to build domestic resilience. And unsurprisingly, real estate prices roll over hard. I mean, imagine what would happen here in the US if the government mandated that banks weren't allowed to lend to real estate. I think real estate prices would suffer. And sure enough, real estate prices went down. Pick any city, they went down anywhere from 25 to 40%. You had most of the big private sector real estate property developers go bust. They couldn't roll over debt. It was a very, very tough time. It's been a very tough 7 years for real estate in China. And just as you would expect, looking at those collapsing bank loans. Now, what happened, I think, in the Western world is perhaps because of our own trauma with 2008 and with the European crisis of 2011, 2012, we saw this real estate bust unfolding. And I mean, if you were reading in the Wall Street Journal or the FT or wherever else articles about China, it was all about this real estate bust. And I think deep down, everybody's like, oh, I've seen this movie before. This is like the US 2008. So the banking system's going to implode and the currency is going to collapse. Like I know the script because we'd just gone through a similar experience in the West. What I think everybody missed was all this money going into industry, and was the fact that actually the banking system was not going bust. It just shifted all of its loans from real estate into industry. And I think the rest of the world, some of the world hasn't even yet woken up to the fact that with China pouring capital into industry for the past 7 years, what you've seen is the Chinese economy transform itself essentially from a producer of cheap goods at a cheap price to producer of high quality goods at very good prices. Now, for people who travel, I think it started to dawn on people around 2023, 2024, when they went to places like, let's say Brazil or Australia or Thailand, and all of a sudden there were Chinese cars all over the road. And I think I have a chart on this. I think it's like page 6 or maybe, page 6.
Slide 7.
Slide 7. All of a sudden, no, actually slide 6, sorry, slide 6.
Oh, okay.
The previous one. This one here. What you saw during this period is China become the biggest car exporter in the world from absolutely nowhere. And this was not selling cars here in the US, a little bit in Europe, but not so much. This was really selling cars to new markets, to Indonesia, to Thailand, to South Africa, and so on. But as people rode in these cars, like, actually, this isn't bad at all. Like, this is not, this sort of challenged the concept we had of Chinese products as being cheap, poorly made, and sort of disposable. And you can say this for cars, you can say this for turbines, for telecom switches, for trains, for earth-moving equipment, for tractors, and the list goes on and on. To the point where we are today. So the policy in China, I think, when you take a step back, has been massively deflationary on two fronts. It was deflationary because on the one hand, you had a big real estate bust, and what you just highlighted, with the real estate bust, people tightened their belt, massive wealth effects, since most of people's savings were in real estate. and so consumption was disappointing.
Yep.
Growth in China was disappointing, et cetera. So you had that deflationary impact. And then you have the second deflationary impact of, if you're Toyota, if you're Volkswagen, if you're Peugeot, now you have to compete with BYD, with Xiaomi, with
Neo,
XPeng, with
Li,
like you name it.
Great Wall.
And again, and this is, China right now is bidding to build nuclear power plants in Saudi Arabia for half the cost of the French, and about 2/3 of the cost of the Koreans. Now, I look at this and I think, as a Frenchman, I always thought, at least we own the nuclear space.
Okay.
At least we got this. Like, we have lots of problems, and I know this isn't the topic today, but we have problems in France, but at least we own the nuclear space, which is, a good space to own. And even there, we got leapfrogged. So I think we're entering a very, very different world now where, China is a proper high-end industrial power.
Yeah, I read today that year to date through August, Chinese companies have manufactured and sold 20 million cars. And in August, just under half of the cars manufactured were hybrid and EV. But I think, and certainly you're on the doorstep living in Hong Kong to Shenzhen, where obviously BYD and Tencent and I think you kind of see going there just, this is not slowing down.
So on this, if I can take you to the next slide, this is essentially the price of a BYD Chin over the past 20 years. Now, a BYD Chin is like a Toyota Corolla. It's a nice sedan, and it's been going for 20 years. So, you like the Toyota Corolla of today is very different from the Toyota 20 years. Now, the BYD Chin of 20 years ago was a really crappy car that cost $30,000 US. And at the time, a BYD worker was making 11 renminbi an hour. So it would take him over 100 months to save to buy a car. Fast forward 20 years, a BYD worker on average makes about 65, I think, renminbi an hour. So a little over basically $10 US an hour. But the BYD Chin, which is now a much better car. So the BYD Chin, the hybrid version, goes 1,300 miles on one tank of gas.
Wow.
So you can drive from Los Angeles to Vancouver and not have to refuel.
Yeah. Well, when meeting with BYD, they actually said, we get so much attention to EV, but they're like,
the hybrid is the story.
But they said, China's a big country, just like the US. And, yes, they have great high-speed rail, but, people, and then northern China, Harbin, really, really cold in the winter. The EV battery's not going to last.
That's
and
right.
They said, they were dying that people would talk more about the hybrid.
I think that, to be honest, I think the hybrid is the story, partly because of range anxiety, but also, so China does have a terrific electricity grid. They've made all the investments, et cetera, but most emerging markets do not have that. Most emerging markets, you look at your South Africa, there's power cuts all the time. Your Colombia's, your Brazil's. So,
California.
Exactly, all the emerging markets. So your EVs, the hybrids, you deal with the range anxiety, et cetera. But, this hybrid, put things in perspective. Again, think Toyota Corolla, 1,300-mile radius. The price today is equivalent to $14,000 US. So it's gone down more than half. Wages have gone up 5x. So it now takes, like, whatever it is, 8 months for 10 months for a BYD worker to buy the BYD Chin, as opposed to 100 months 20 years ago. So this is why now, when you visit the ports in China, when you visit, factories, it used to be that it was all bicycles. You'd go into the parking lot and it was all bicycles. And now it's a lot of cars. Now, to your point, in China, a lot of them are EVs. They're EVs partly because a lot of cities, so if you're in Shanghai and Beijing, before you buy a car, you got to get the license plate. And if you want to get a license plate for a non-EV car, it's like a 2 or 3 year waiting list in most of these places. An EV car, you're going to get in a month. So they're really pushing people through regulation, through subsidies, through price to move to EVs. But again, in China, this broadly makes sense because the grid is adapted to it.
Now, it's overnight. This literally just that they said starting January 1st, EVs will no longer be exempt from sales tax, that EVs will go from 0 to 5%, which is still a significant discount to the 10%. And I think, does that, on the next slide, you have this great talking about what I think is a really interesting trend and on the next slide as well. I kind of thought to myself this morning, is this sales tax being put on EV? Is this part of the anti-involution campaign? This idea of you have excess capacity in solar, steel, cement, auto. They mentioned e-commerce, though it's been pretty quiet on e-commerce, and despite this vicious restaurant delivery war. But what's your view of anti-involution? Is this something we should be I just think if I'd love to hear your description of it, and then is this something that us as fundamental investors, is this something that we could be getting excited about? Is this the end of China's deflationary spiral? Is it the end of China exporting? Could some of these Chinese companies raise net income? I mean, that's kind of the ultimate outcome. But what's your view, Louis?
Look, my own personal bias, having lived there for 30 years, is that I think Chinese policymakers have a decent track record of saying what they do and doing what they say, and that it does pay to listen to them. And yes, in recent months, Politburo members, including Xi Jinping, have been out in force talking about excess competition and launching the new buzzword in policy circles in China today is anti-involution. And involution is essentially means excess competition. So now I think, again, going back to how to understand China in recent years, again, you go back to 2018 and this belief the US is out to get us. So we have to build up resiliency across all sectors. You get to this year, and I think a key moment this year was the release of DeepSeek. When they released DeepSeek, all of a sudden there was the realization that even at the very pinnacle of technology, where really the US was trying to prevent us from growing, where the US was, making sure that China didn't get access to the best chips, etc. Even there, China actually could find workarounds and keep up. And I think that gave them enough confidence so that when in April, if you go back like 2018, President Trump basically punches China and China cowers in the corner. China takes the punch, doesn't respond. 21, Biden comes in, terrible Anchorage meeting between Blinken and Sullivan and Wang Yi. It's terrible. And again, they take the punch, don't respond. 25, Trump comes back in, and again, like more tariffs, like punches China. But this time, China stands up and says, essentially, okay, and it's pretty much the only like the EU folds, Canada folds, Mexico, everybody folds. But China's like, okay, you want this? Like, let's go, gloves off, and let's do this now. What China does at that point is it actually plays its trump card, no pun intended, of like banning rare earths and banning magnets. And the U.S. realizes, hold on, we're 3 weeks away from not being able to produce missiles. We're 3 weeks away from not being able to produce cars. And so at that point, I think China realizes, and so the U.S. backs off. We have the Geneva talks with Besant, et cetera, compromise is reached. And so I think at that point, China's like, all of a sudden, it's like, okay, we're good. Like the U.S. can't really mess with us. We've got our whole supply chain. We no longer need to send good money after bad, especially since actually our problem today now is no longer the fact that the U.S. is out to get China. If you're a Chinese policymaker, your problem today is really the problem illustrated on page 10. And it looks like a bunch of crazy numbers that make little sense. But essentially what this table represents is consumer confidence in China broken down by where people live and broken down by age groups. And what you find is that, essentially old people who live in the countryside are miserable, which, is very understandable. They're the ones who've been left behind by prosperity, et cetera. But... And
how much of that is also because, I remember, on one of my trips this year, going to Shanghai, I mean, they were building in Pudong like crazy. I'm like, wait, China's having a real estate crisis and there's buildings going up left and right. And Actually, I drove by the NVIDIA building. I took a photo, but people were like, "You're in the richest city, in the richest neighborhood in all of China, and in the hinterlands, that tier four, 3, 4, 5. I mean, the decline in real estate prices.
But so this is fascinating about this table, because in this table, you basically it highlights. Okay, forget the old people in the countryside.
Okay.
The other very unhappy people in China are the millennials living in the first and second tier cities, and they're very unhappy because obviously they've been the big victims of the falling real estate prices. They're the guys who bought real estate prices on the wrong, bought high, geared up their balance sheet, etc. Now, you would think, you're right, that the biggest bloodbath in real estate is in the third and fourth tier cities. This is where you have the most excess supply. This is where some of the excess supply probably just needs to be written off to zero. It's not going anywhere. But it's funny because the guys in the third and fourth tier cities aren't that unhappy. And I think for a couple of reasons. First, when BYD moves from having 300,000 workers to like 2 million, these jobs, they're created in third and fourth tier cities. Like BYD isn't putting a factory in the middle of Shanghai. They're putting factories in cities that you and I, 5 million person cities, but we still never heard of them, even though we do know China. But also, I think if you live in Shanghai, if you live in Beijing, your life actually hasn't changed all that much. You used to have a subway, you still have a subway. You used to have a municipal pool, you still do, etc. But when you look at the public infrastructure in a lot of these third and fourth tier cities, now you have a high-speed rail. Now you have an airport. Now you have a municipal pool and better schools. And so a lot of this, the infrastructure that has gone on, it's really changed the quality of life much more. Like the gap has essentially closed between the first and the third. So all this to say, if you're the Chinese government today, your concern no longer is how do I protect my economy from U.S. attacks. I think that has now been established. That's done. Your problem now is essentially, if I can take you to the next slide on page 11, your problem is that with the millennials being so unhappy, you've seen an absolute collapse in the Chinese birth rate. You've gone from essentially China having 17 to 18 million babies a year to 9.5 million babies a year. This is now, part of that is COVID, being locked down for 3 years, that's obviously you had a collapse in weddings, so no weddings, no. So there's a lot of factors here. Some of that is structural. China in the past generation has moved from having 350,000 university students a year to 12 million university students a year. So people have moved from the countryside to the cities. People live, we're in your very nice office here. That's probably the size of a good size apartment in Shanghai. So lots and lots of factors to this collapsing birth rate, but this is now the number one priority in China. And so I think the message from the government, going back to they say what they do and they do what they say, the message from the government is now telling the banks, look, for 7 years we told you if a guy has an industrial project and walks through your door, you give him money. Now, no more. We're not adding capacity on top of capacity. So I think when you look at the anti-involution campaign, the first step is let's stop just runaway industrial investment. And yes, if you're Toyota, if you're Peugeot, if you're a ball bearer manufacturer in Wisconsin, you're breathing a deep sigh of relief, because China always adding capacity, that makes it very hard for you to compete.
For sure.
So there is that element. Now, whether they take capacity off, I think that's going to be much harder. But you were mentioning EVs. EVs, China today has 100 EV producers, and all of them were funded by banks. Out of the 100, there's probably 5 or 6 of them that actually are profitable. Like BYD is profitable, Xiaomi is profitable, but there's not so many. You're not going to go down to 5, but as you cut the lending, are you going to go from 100 down to 50, down to 30? I think it's very possible. Now, you could say, well, that's great news for BYD, right? It's good news, less competition. And here, this is where Chinese capitalism could get wonky, because we don't know yet what's going to happen. As those guys go bust, do they let them go bust? Then that's good news for BYD. Or do they tell BYD, hey, BYD, you need to take over this guy, that guy, and that guy, in which case that's not great news for BYD. And the answer is the anti-involution campaign is still very, very fresh. It's the new thing. Now, the stock market is undeniably liking it. Because look, for 7-8 years, policy in China was fundamentally deflationary. Like, that twin deflationary we started talking about. Now, you've moved forward to today. You've got a government that's running budget deficits of 10% of GDP. You have the easiest monetary policy in the world and also in China's history, and they keep cutting rates. And now you have this anti-involution campaign, which is fundamentally a reflationary campaign.
Yeah.
So you look at all of this, it's not a surprise that the stock market likes it. And it's a stock market that is cheap and that has massive policy support. So you look at it, you got a cheap stock market with strong momentum, massive policy support that's under-owned. It's like, it ticks all the boxes. Like, if you don't back up the truck now, it's like, when are you going to back up the truck?
Yeah. And you've got a lot of work about this huge amount of excess savings in China above trend because of zero COVID, because of real estate. And, I think you're starting to see this asset allocation shift, just interest rates in China very, very low. Your bank accounts, bond market, just not giving you the same yields as historically. So why would you not buy some high dividend yielding stocks where you actually earn more than in a bank account with upside? And then really more recently is, I think, the DeepSeek, the AI cloud data center, robotics. I mean, Cambricon, just even today, I wrote about it in today's China last night. Just you look at the 10 most heavily traded stocks in China, not by volume, but by value. And nearly all of them were up double digit. And they're all, because of this Oracle OpenAI deal. Yep. But I think in general, there's you've got this re-rating of Chinese equities. It started in China with the Chinese. I think in Asia, you have money kind of rebalancing. The commodity world is always geared to China. Yes. So, my little joke is the best Brazilian China economist is the CEO of Vale.
Yes.
In Australia,
what's happening.
In Australia, it's BHP. In Switzerland, it's Glencore.
No doubt.
In Chile, it's SQM. Southern Copper in Peru, whatever. So I think we see this re-rating happening, and just the flows. It's the U.S. investors, I think, have been a little bit behind. And so, listen, the U.S. has done fantastic over the last.
I was about to say this. I think China last year was the one market that outperformed the U.S., and China this year is outperforming the U.S. again. But the U.S. it's doing fine.
Yeah.
So I can understand why, if you're a U.S. investor, you're like, oh yeah, well, great, that's cute. China's having a bull market, good for them. Yeah. Like I'm doing my thing over here, and this is fine. But I want to go into something else, because you mentioned the rebalancing. Mm-hmm. And I think this is an important fact, because, look, a couple of weekends ago, we had the SCO meeting in Shanghai. You saw the pictures: Putin, Modi, Xi Jinping hugging it out on stage, holding hands, looking like best buddies, and announcing all sorts of deals, like the Siberia 2 pipeline, which, if it comes through, would mean that essentially China gets all the natural gas that used to go to Europe at a very discounted price for the next 30 years and paid for in renminbi. So for China, it's a great deal. But even beyond that, for me, the big question is this: as I look at these pictures of Modi, Xi, and Putin hugging it out, is if you take Russia is essentially the world's cheapest commodity producer. China is the world's cheapest producer of capital goods, and and today has the cheapest cost of capital. It's got the lowest interest rates, and they continue to go down, partly because of all these excess savings that you were mentioning. It's got a very low cost of capital. And India has today the world's deepest and cheapest pool of labor. Because, labor in China, you and I have discussed this in the past, labor in China is no longer cheap.
Yeah.
it's more expensive than in Turkey. It's like basically the same price as Portugal and Spain almost now.
Yeah.
So it's like, it's not cheap, like we would understand cheap. It's like,
yeah. I mean, I would always say that
it's more expensive than Mexico.
My Costco undershirt.
Yeah.
This unequivocally was made in Shenzhen 10, 15 years ago. Is being made in Bangladesh.
Oh, for sure, Bangladesh or Indonesia or
pushed out. The low end clothing. It's just
and the plastic toys that you buy for kids and all that stuff. No, China has moved up the value chain in terms of industry. They make cars and tractors and stuff like that. But if you think of it, you take a step back. Like if you're now uniting the cheaper producer of commodity with the cheapest capital goods, cheapest cost of capital, and cheapest labor. That's got the making of an economic boom of epic proportions. Now, this is where the rebalancing comes in and is fun, is if you take a step back and you think, you take your 50 top market caps in the world, how many of them are exposed to, if you start off with the premise that, this integration of China, India, and Russia, which is highly hypothetical, but if it does happen, is going to be a macro trend that completely reshapes the world, completely reshapes the world. If you start off with the premise that there's a chance this is going to happen, how many of the top 50 market caps in the world are going to participate in that? And the answer is, out of those 50 market caps, maybe Tencent, maybe Alibaba, and that's it.
Guess how many U.S. listed companies generate more than 25% of their revenue in India?
Oh, none.
One.
Oh,
there's an insurance company.
Okay.
I don't know what they're doing, but one. I mean, I was shocked where, versus you think about U.S. companies that have done very well in China. Obviously,
and there's lots of them.
There's a whole
Apple has crushed it in China.
Apple, Tesla. I mean, my favorite is ExxonMobil.
There's lots of them you don't. You're right. There's lots of them you don't think about. McDonald's.
Yeah.
There's loads of them. I mean, Starbucks is getting crushed now in China, but for years they were crushing it in China. So there's lots of them for sure. But I highlight this because I think as you project yourself for the next 10 years, you can think, okay, what are the macro trends that seem to be unfolding right now that are going to rechange the world? Now, I think to what you were saying, in the US, people will immediately say, well, it's going to be AI. Like AI is going to change the world, et cetera. Maybe it is, or maybe AI turns out to have been something that we poured billions in, hundreds of billions, with very little returns. We'll see, how the returns on capital end up there. So maybe that's your macro trend. Maybe another macro trend, people will say, if you have the gold bug persuasion, you'll say, it's the collapse of the fiat currencies, and we need to move towards crypto or like variations of fintech, et cetera. So maybe that's one macro trend. But there's another one emerging right now. Now, by the way, if you think AI is the big trend, and you look at your top 50 market caps, you got lots of that in there.
Yep.
You got your NVIDIA and your Microsoft. So if you're buying your S&P 500, you are exposed to the AI thing. And if it turns out to be a dud, you're also exposed, but on the wrong side. But the Russia-China-India integration, perhaps because it's pretty new, is simply just not reflected in markets whatsoever. And perhaps there's a huge opportunity there.
I mean, I think as students of China, we've always felt, there's no country that does infrastructure like China, and what an opportunity in India for putting that know-how to work.
So on this, I'm sorry, I keep interrupting you. I apologize.
That's why you're here. That's why you're
I apologize, but it's when it comes to physical infrastructure, building roads, airports, that kind of stuff, China is world class. And they've done more of it than anybody else over the past 20 years, and not a little bit more, like more by a factor of 10. Like so at this point, they can come in and lay cables and put down roads better than anybody, or build a railway better than anyone, just out of the sheer experience they've accumulated. Now, India, of course, is the part of the world that does need infrastructure, all that physical infrastructure. But what's fascinating when you do travel to India, and I go there a couple times a year, is while the physical infrastructure hasn't been that great, the whole sort of fintech infrastructure, the whole internet infrastructure, et cetera, e-commerce infrastructure, India is actually world class.
Yeah.
And like quick deliveries,
Sure. Mobile payment.
Mobile payments, quick deliveries, all that stuff. They're actually far ahead of the Western world, and they are world leaders. So it's the old joke that in India the economy grows at night because that's when the government sleeps. This is the part of the infrastructure that really didn't need government, like the whole fintech infrastructure, etc. That like people in India just did it because they have tremendous entrepreneurs, they have tremendous business people. Of course, building roads, building railways, that requires more government intervention, and in India that takes more time.
Yeah.
But they are getting it done.
Yeah, and I know, based on your, living in Hong Kong, you're basically looking out at Shenzhen, the proverbial Bay Area or Silicon Valley, and I think it's just kind of interesting to me, not just based on what's happening in terms of markets, particularly these growth stocks in China, both mainland as well as Hong Kong and the ADRs. The growth stocks are really leading the way, but it's interesting to me that you're starting within Gavekal, you're starting a new kind of China tech focus, and what drove the foundation of this new effort? Obviously, we're consumers, not just Gavekal, but the Gavekal Dragonomics. But I know you're doing something very specific to kind of China tech.
Yeah, no, we have a separate tech product. To be honest, we had an embryo of it for a long time. Essentially, once we realized that the U.S.-China relationship was deteriorating, and that the U.S. had picked essentially tech as the battleground where the fight with China would happen, we just felt, okay, we have to do more here. We have to understand better what's happening. Once it became pretty clear, which was about 7-8 years ago, that China would need to build a parallel ecosystem. That the U.S. was essentially telling China, you can't be part of our tech ecosystem. So China had no choice but to build it.
Yeah.
Then you got to very quickly the question, okay, how are they going to do it? Are they going to be successful at it? Because if they're not successful at it, how can you be a modern economy without a tech ecosystem? So it became a linchpin of having a China view. It became, not having a view on how China tech was going to develop meant you couldn't really have a view on how the economy in general was going to develop. And so we hired people, and we've been doing more on that front, and sort of several years in, I think it becomes increasingly visible that not only is the Chinese tech ecosystem viable, and yes, you could say they haven't yet caught up at the high end of semiconductors, et cetera, but they are catching up much faster than we expected, number one. So not only are they, could we expect some catching up, but looking at this tech ecosystem, what's actually increasingly interesting is how the ability of China to export this tech ecosystem. You take the telecom switches as the obvious example, where Huawei, essentially, you can't find an emerging market now that doesn't have Huawei switches. You go to Brazil, you go to anywhere, and I would also even argue that when you're in the Western world, sometimes part of the Western world, like the UK, that have completely refused Huawei, it feels like mobile internet isn't as strong. It feels like calls get dropped more. So anyway, bottom line, I just think that to have a view on China, you need to have a view on Chinese tech.
Yeah. I mean, certainly, we see this playing out. I mean, just even overnight, Alibaba issuing this convertible bond, raising I think it's $3.2 billion. 80% of that to bolster their AI cloud efforts, and I think it just shows the investment in the space from the leading players. And I think normally you'd be like, oh my gosh, convertible bond, dilutive, bad, but actually this 9988 it rallied, and then obviously huge inflows from Southbound Stock Connect for Hong Kong in general, not just today, but particularly to Alibaba. So it's interesting.
So you mentioned Shenzhen, and I want to come back to this because obviously Shenzhen is our neighbor city in Hong Kong. It's in fact we now have a high-speed rail
Yeah.
between Hong Kong and Shenzhen. It takes 18 minutes.
Yeah.
The idea was, oh, this is going to be great. We're going to get all the Chinese tourists coming into Hong Kong.
Other way you're going up there to buy groceries?
Exactly. This has become a big problem for Hong Kong because China is so cheap today.
Yeah.
China, and I keep telling everyone, like, if you want to take a cheap family holiday, go to China. Like,
I agree.
you can stay at the Four Seasons Hotel in Beijing, Shanghai for $100 a night.
I mean, obviously we're passive investors, we're ETF providers. There's one place in the last year to date, I've stayed at one Ritz-Carlton, and that was in Shenzhen because it was I think it was $125 a night US. I mean, just
good luck finding a decent hotel or even just a hotel room for decent.
Yeah.
When you compare to the prices here in New York, it's quite a stretch. So China is dirt cheap. So yes, you come to our office in Hong Kong on a Friday, and you ask the guys who work in our office, what are you doing tonight? They're all taking the train to Shenzhen because the bars are half the price, the restaurants are half the price. So everybody goes across. This just illustrates how massively undervalued the renminbi is. But also, what's fascinating to me, so I've been in Hong Kong 30 years. Shenzhen, frankly, used to be a dump. It used to be, 30 years ago, you had a few factories amongst rice paddies, but like the idea that you would go on a Friday night to party in Shenzhen, but you go there now, you've got world-class restaurants, you have, all the, the Nobus of this world, etc. And it is now super, super hip.
Yeah.
And the same is true for Shanghai, the same is true for Beijing. So these Chinese cities have evolved. Like, most people haven't gone since before COVID. They've evolved so much in the past 5 years. The Chinese economy has evolved so much in the past 5 years.
Yeah.
The public transportation is faster, cleaner. It really is like, if you're not going, you're doing a disservice to yourself, because you have to see it with your own eyes to see the progress that has been made in such a short period of time.
I couldn't agree more. I mean, it keeps evolving, it keeps growing, and there's no going backwards. I mean, for sure. I mean, and certainly for those with questions, please, you can email us at info@kraneshares.com, as well as just using the Q&A chat button. So I'll hog the first question, which is it feasible that anti-involution could some of that be to placate the U.S. that an argument has been China floods the world with this cheap stuff. In theory, this could curtail a little bit of that. We've seen that, very quickly with solar and polysilicon prices. But, is it feasible that this is a little bit of the give and take? I mean, I feel like under Trump, who has more of an ear to U.S. corporate interests than the previous administration, a U.S.-China trade deal, or at least improvement of relations. Just yesterday, you had Rubio as well as Hagsbeth actually spoke to their counterparts. The first U.S. first members from Congress will visit China since first members of Congress from the House since 2019. But could anti-involution be part of placating the U.S. a little? And it's definitely more geared domestic. But then, maybe broadly speaking, how do you see kind of U.S.-China relations playing?
I think the U.S.-China relationship is on the mend, because indeed, China stood up. The U.S. realized, actually, we are vulnerable here. We can't keep pushing them. You'll have noticed that in the past 6 months, nobody's mentioning Taiwan anymore. When you couldn't open a U.S. paper without being told that it was either next month or the month after that Taiwan was going to be invaded. So all of a sudden, and I've got the Google search on Taiwan in there, but like all of a sudden, it's like nobody mentions Taiwan anymore. So I think the relationship has found a sort of, perhaps unsteady, but a sort of unsteady balance. Is China doing the anti-involution thing to please the U.S.? That might have played in it. It's like, oh, this will please the U.S., so we might as well do it. But I don't think that's the deciding factor.
No.
The deciding factor is they do have excess capacity in industry. Just like 7 years ago, they had excess capacity in real estate, and it was time to say, okay, no mas. I think we've reached a point where it's like you have 100 EV makers, where you're going to go to 150 EV makers. It's like at some point, it's like, okay, wait, maybe 100 might not be the right number. Maybe like 50. And if we keep going, we're going to go to 150, which creates more problems down the road.
Oh yeah, I mean, I'm sure you've been to the right in central Shenzhen, next to the train, right near the trains. I have to admit, I got off at the wrong station, which was I went one too far.
Okay.
But when I finally made my way back with my help of some, I was alone, so it was interesting, and I had no Riembi on me.
But actually, on this, I mean, especially a place like Shenzhen, a lot of people speak English now.
I was lucky.
It is easier to travel than it was, say, 15 years ago. Like you grab anybody who looks under 35, and they'll speak English.
That's true. That's true.
But like 10 years ago, you might still be there.
Yeah. But I went into that mall right there, and I feel like I'm pretty conversant on the China, and there were makers I had never heard of.
Oh yeah, well, there's 100. Yeah.
The whole first floor is just auto.
I don't know. Like it blew my mind when I didn't go back to China for like 2.5 years during the COVID years because you couldn't travel, you couldn't do anything. As soon as they lifted the restrictions, I flew because I wanted to see my team up in Beijing. We have 10 people in Beijing, so I flew in, and and yeah, same story as you. I was just walking around the malls and like, what is this company that I've never heard of?
Mm-hmm.
Of course, you knew BYD and I'd heard of Xiaomi, but it's like all of a sudden it's no. Look, so I think there's a lot of drivers to the anti-involution campaign. Whether they want to please the U.S., it's not just a problem. The excess capacity is not just a problem with the U.S. It's a problem with Japan. It's a problem. It's a problem with the EU, etc. And so I think there is an element of in China of trying to keep a good relationship with the EU. They start off with the premise that they're going to have a confrontational relationship with the US, but at least try to keep a good relationship with the EU and keep a good relationship with Japan. Because Japan is a massive investor in China as well. Let's not forget. So, there could be many factors driving anti-involution, but whether it's let's make the U.S. happy. Let me take if I wanted to make the opposite argument, I do think they want an even keel. But 3 weeks ago, President Trump came out and said anybody who buys energy from Russia, we're going to punish. Mm-hmm. We're going to do extra tariffs, etc. And a week later, Xi Jinping says, you know what, Putin, that pipeline you've been lobbying me to build for the past 15 years, because Russia has been lobbying China for 15 years to build Siberia 2. And Xi Jinping picks this very moment to say, okay, fine, we'll build this pipeline. Now, you could say he did it for commercial reason because Putin was on the ropes, gave him a deal he couldn't refuse, et cetera, et cetera. But the U.S. Trump could not have been happy at that announcement. Just like Trump could not have been happy looking at Modi, Putin, and Xi hugging it out. So I think China does want to have a better relationship with the U.S., but at the end of the day, it still is driven by its own national interest, which is what every nation does.
For sure.
There's Lord Palmerston's old quip that there are no permanent friends or permanent enemies, just permanent interests.
You very generously allowed us to share your presentation.
Yeah, absolutely.
So this, if you'd like, and it just shows that there's a lot more to Gavekal than just China. Gets into your global macro work. So just email us at info@KraneShares. We can get you the presentation. But two kind of related questions here, just around. Around semiconductors and AI, How do you kind of see China? We've seen the performance of a lot of, we see this, a lot of these starboard names, obviously just up over 100% year on year, but certainly even companies like Alibaba, I think a big part of the driver from which were not great earnings in August. How do you see that playbook kind of playing out? And then a little bit more specific, our great friend Matt, out in Leawood, Kansas, he's been following this out of Chinese universities, have been the development of these new semiconductor chips that potentially kind of bypass some of the U.S. technology. It's very specific. Maybe we'll follow up for your China. We'll get back to Matt. Just because this is to your research colleague in China on this question, but how do you see kind of semiconductors? We've touched on this a little bit, but how do you see this playing out? Are they really going to disrupt NVIDIA? But I actually think it's probably a bigger worry for some of the lower end. If you think about it, Texas Instruments, Qualcomm.
Yes.
That's Intel.
So I wish you should have not going to plug us even more, but you should invite my colleague Layla, who covers all the semiconductor space for us, and she'd be much more of an expert than I am to answer all of this. Look, here's what I do know on semiconductors, is that it's undeniably a big focus of the Chinese government to be self-sufficient in semiconductors, and they're pouring capital at this, both human capital in terms of pushing entire university departments and students, etc. And roughly half of the world's STEM graduates in the world today come out of China, so they have the human capital to throw at this. And incidentally, I don't know what it is about Chinese culture, but it seems that just like Indians seem to do very well with software, Chinese tend to do quite well with semiconductors. You look at obviously TSMC. You mentioned NVIDIA. Jensen Huang is from Chinese background. CEO of AMD is Chinese background. CEO of Intel is now of it's, I don't know what it is about Chinese culture, but it seems that is it the characters? Is it the way that math is taught there? But I always thought it was weird for the U.S. to pick, of all the areas, say we're going to have a fight with China and we're going to pick semiconductors as the place where we're going to fight that fight. I always thought it was weird because semiconductors is actually one of the most capital intensive industries out there. Like building these fabs costs tens of billions. R&D costs billions and billions. It's massively, massively capital intensive. Now, like the one thing China has shown time and time again is absolutely zero concern at throwing billions into projects. It's like we have the money, have the engineers, we'll use both.
Well, it's similar to rare earths, where rare earths are not necessarily that rare.
They're not rare at all.
It's very few countries are willing to suffer the environmental consequence of processing them. And I'm a little bit of a skeptic of, this U.S. rare earth renaissance. Just, what
you've got none in my backyard in the U.S.
It's just
nobody will want a rare earth refiner in their county, in there. It's just,
the closest thing you can find is what Canada's done with the oil sands. But it's they just turned part of their country into the dark side of the moon, and I just don't see the appetite. The beautiful blue skies here in New York.
They did it, and they started sort of 30 years ago. I think if you were starting from scratch the tar sands today,
wouldn't happen.
You'd have a hell of a time to get it off the ground. And so on the rare earths. Japan, China, this isn't the first time China plays the rare earth card, because they played it against Japan back in 2011. Do you remember they had the tiff over the Diaoyu Islands? And China said, okay, well, no more, we're going to restrict the rare earths to you, which incidentally, I think was one of the driver of Toyota saying, well, we're not going to go down the EV route. We're going to do hybrids and hydrogen car. Because they were worried that, if you can't get the rare earths and the magnets, then you can't do the EV cars. And so Japan said, okay, well, we have to spend billions building our own supply chain. Now, they used to have 90% of their rare earths come from, in 2011, come from China. They spend billion building plants in Malaysia, building mines in Australia, building refineries across Southeast Asia. And so what is it, 13, 14 years later, they're down to 70% coming from China. Like having spent, and Japan is actually pretty good at industrial efforts. Like when the Ministry of Industry says, okay, we're doing this, they'll pour capital into it. I think perhaps much more so than the U.S., where the U.S. has so many strengths. Like you get, U.S. has pocket aces. It's in the competition between nations. It's got so many strengths. But I don't think industrial policy is a strength of the U.S. And it doesn't matter because you got all these other things going on.
Right.
You don't need to have industrial policy. Not that governments are good at making industrial policy anyway. But so the whole, the U.S. is going to build these rare earths. If they do, it's going to take 10 years.
Yeah. Well, I think that's ultimately why we're hopeful that the U.S. and China governments can take a page from the U.S.-China corporate world, where people are getting along just dandy with one another. They're getting along, but
I think we're getting there. To be honest, I think the relationship. Look, China just announced this pipeline, and the U.S. didn't retaliate. Didn't do anything. In fact, I think the odds are pretty high that at some point Xi and Trump will meet. Maybe as early as the APEC summit in late October, early November in Seoul, and then when they sit down. Maybe Trump removes the 20% fentanyl exports. Maybe China agrees to revalue the renminbi. Maybe China agrees to buy a little more treasuries, enough to say, okay, Trump can walk out of there thinking, I've got to win here.
Oh, I think the 600,000 students, right?
Yeah.
That is a service export from an economics perspective, and this is.
Well, I think on this, the U.S. realized. I think. When Trump said, okay, we're going to ban exports, I think he thought that would be like a card against Xi Jinping. Xi Jinping is like, yeah, what do I care?
Oh, it's 12% of exports go to the U.S.
Yeah. No, but like the whole, we're going to ban your students from coming here. I think if you're Xi Jinping, it's like, great. I don't want these kids to go to the U.S. Right. Half of them become American. The other half come back and are pro-American. I'd much rather they stay here. And go to my local universities.
Right. That's a good point.
So I think as a card to play against China, that was not such a strong card.
Okay, interesting. Well, again, Louis, I know you've got a noon institutional meeting here in New York, and we're just really appreciative that you spend the time with our clients, and certainly for those interested in Louis' deck, please email us at info@KraneShares. Certainly for those interested in Gavekal, how would they get in touch with, besides going to your website?
I think that's actually the best way.
Okay.
Go to the website, gavekal.com. That's probably the best way.
And we look forward to hosting Leela.
Like she can go deep down into semiconductors in a much more cogent way than I can.
Okay, well, certainly welcome to New York. Certainly
Thank you.
Great seeing you, and hopefully you have a prosperous trip here in the United States.